Welcome everybody to today's webinar. This class does not cover any credit, but it's just one of those excellent, great webinar presentations by Dave. I just love these programs they have. Dave Oliverio brings an impressive 30 plus years of experience in mortgage banking to the table and currently serves as the branch manager for New American Funding. As a top 1% originator in lending nationwide, Dave is recognized as a true leader and expert in the field of real estate financing. His unparalleled knowledge of real estate loans and credit complexity sets him apart as a trusted resource for both professionals and consumers. And if you're working with Dave, you'll see unbelievable flexibility and options, which he's definitely a puzzle person. Not only is Dave highly accomplished in his career, but he's also really the most skilled lender I've ever used. I've done 4 refinances with him, and my oldest daughter has done 2 purchases. He's exemplary. I call him the magic man. I always ended up with a better result. And I never had that experience with anybody else. It was just always so well done, so under dramatic. It just really, really, really a good lender, and his team's really good too. And they have really good, genuine care. And that really it's always been important to me, and it was always hard to find. In addition to his lending accomplishments, Dave is a valued member with us. He has a passion for teaching. He really wants to make sure that you know what to do and what things to use to do more business. And he is definitely a favorite among real estate agents and consumers alike. So, Dave, take it away.
All right. Very, very generous. Very nice. Thank you, Cindy. And I've said this before. I do try hard, but quite frankly, I don't care how good you are as a branch manager or a loan officer. You have to have solid company support, or you're going nowhere. So fortunately, I haven't been with many companies over the years, but the companies that I've been with, they've all been, quite frankly, top notch, good companies. You could count on them, and that's helped, of course. But Dave Oliverio, branch manager at New American Funding. I've said this many times before. Our goals, not just in these webinars, but in our financing classes, which have had many good ones, is to add value to your profession, uh, see if we can enhance your relationships with your current clients. And I've said this many times, if we can come up with some ideas that will trigger new business for you, then that's our ultimate goal. And in some of these classes, we've been able to do that. A webinar like this just might, and I'll throw in some other, because things are happening pretty quickly. So I'm going to address some other programs that have helped generate new business for agents in this next half hour or so. So we'll move through it pretty quickly. And if you do have any questions, feel free to give me a call. But so let's get started here. We're going to focus on 2 programs, but I'll bring up a couple other programs. But this is what is happening, and I don't think I have to. I think probably all of you probably are getting a touch of this. Is that lenders have to get more creative in a very tough competitive market to keep doing business. And creative means new loan programs, solution finders for the realtor community and our borrowers. So that's what has been happening, quite frankly, over the last couple of years. But what I've noticed in the last several months, a fair number of loans that we have done have been not necessarily out of the box loans, but not a Fannie Mae loan, not a Freddie Mac loan, not a standard fare jumbo loan with reserve requirements and ratio requirements, uh, and full doc. So none of that, but we're doing these a little more out of the box programs. Many of you have heard of the DSCRs. That's that self-employed borrower that has plenty of assets, but on those 1120s, on those corporate returns, not showing much income. So we have literally a no income, no employment loan for those self-employed borrowers to buy an investor property. And it's based on it's based on what the subject property can generate in terms of cash flow per month versus the principal, interest, and taxes and insurance payment. And that has spurred some new business for the realtor. Because I've had a realtor call me, hey, I've known this, he's been working for 20 years. I know he's doing great, doesn't declare much income, but he wants to buy a property. That's the type, and there are many, many, quite frankly, as I've seen it over the years, there are a lot of successful self-employed, and you all know this, self-employed people that have assets but are not showing income. And that DSCR loan is a great loan. Just the other day, we just closed one. It was a little different, but he owned a home in Arlington. He wanted to buy a condo in Breckenridge, Colorado. Uh, uh, so what we did is we refinanced a single family in Arlington, took like 500,000 cash out so he could pay cash for a little condo in Breckenridge. So no income, no employment. So basically, the programs are out there now. The company that I'm with is a progressive company. I'd say, quite frankly, we're not the Lone Ranger, but we have them all. We have every product you can think of, but quite frankly, most likely your favorite lender is not sitting on their behinds. They probably have many of the same programs that we have. These two programs that we're going to go over today, I believe, are different. And the survey that I've done, I don't believe that there's another lender out there at the moment that has these programs. There may be, but the ones that I'm familiar with. So I think these programs are pretty different and pretty interesting. But bottom line, there are many good programs. We closed one a few months ago. Now this was on what's called a 1099 program. Who our borrower, an Uber driver, okay, making 120,000 a year, 130,000, 1099 income from Uber, but claiming like 35,000 in after expenses. So where are you going to go with 35,000 in this area? But on the 1099 program, we were able to use that 10,000 a month or so. We had to take out 10 to 15% for expenses, but that a long way. Now, once again, that is not a Fannie Mae program, but any Uber, Lyft driver, and most of them are in that, like they'll make a lot of money and they expense most of it out. So we found a way, and quite frankly, what I've seen also is the rates on these, what's considered non-Fannie, non-Freddie, non-jumbo, not standard fare, the rates are fairly palatable. They're not like 9% or 8% or 7 7/8%. We've been able to get low sevens, high sixes. The one we did the other day, of course, he took a 3-year prepayment penalty. It was an investor property, and we hit the market perfect timing, but it was like 6.5% on an investor program. I think it was 1 point total. But consider an investor, cash out, refinance. So I guess long story short, I wouldn't give up on anybody that you see, or these self-employed people who are not showing income on their tax returns. Are they getting 1099s? Do they have good savings? There may be a way for them, and if they're not getting 1099s, but if they do have good savings, do a no income, no employment on an investor loan. So I do think there are a fair number of solutions out there. So this
What's the interest? Dave, what's the interest rate on that one?
On the all cash, no income.
Yes,
uh,
sir.
Yeah, uh, I would say fairly with 25% down, you're looking at probably 6 and 7/8 at no points. Uh, if we did a 3-year prepay, probably knock 1/4% off that. So you could probably get pretty close to 6 and 5/8 maybe. And that's an investor, no income, no employment. So under 7. The 3-year prepay does have, and see, there are many investors, they're okay with the 3-year prepay because they're not going anywhere. Uh, uh, and then after 3 years, but these are, I'd say, uh, these are the programs that if you think about it, then you do maybe some research that you might be able, for those people who think they're not buyers, you may be able to find them a property, create some new business for yourselves. The NAV cash program simply means that our company writes the first contract. So you would be presenting the contract. We are the purchasers. So you present, we're the purchasers. Literally, our company is the purchaser. And that's in the whole. This is the whole purpose of this all cash program. The whole purpose is to, one, if our current borrower has a property where they have plenty of equity, but they want to buy a home first, then sell their property. When I say plenty of equity, I mean plenty of equity. They have to have 30% net equity in their current home, but will also use savings retirement accounts to get to that 30% net equity. So it's for that borrower who has a lot of equity in their home and may have a lot of retirement savings that wants to purchase before they sell their current property. And we can do that without carrying the debt on their current property, as long as they have 30% net equity, including savings and retirements, that we can throw that in. Just as an example, we had just closed one in McLean. Well, when I say just closed one, it was last month. So on 10/15, we closed an all cash in McLean. Our borrower has a home in Falls Church, but wanted this without carrying it, without selling home, because obviously she had a $5,000 payment on the home in Falls Church. So, okay, how could we get her into that home? So what we do is, yes, she has to qualify, but we qualify her on the purchase in McLean. We disregard whatever payment she's making on her current property. And as long as she could qualify on the purchase in McLean, we're good, and we'll pay all cash for that property. So there is a process. Okay, on that property in McLean, let's say 900,000 sale price, what down payment is, so we make sure from her current property that she has the equity when she sells it to make that down payment and to qualify for the new property. But literally, we're not carrying the current house payment. Now, she happened on this property, she had plenty of equity. We had the 30% net equity. It was like a 900,000 sale price. She was putting a lot of money down, but basically we qualified her with 25% down on the new property. So 925% down, not carrying the 5,000 worth of debt, she was fine. So when the seller got the contract on the home in McLean, seller sees an all cash offer with one contingency. And that one contingency is a home inspection contingency, like a 5 to 7 day home inspection contingency. No appraisal contingency, of course, no financing contingency. So when in the home was not unpopular. It was in a nice location in McLean. And they had a lot of interest. Matter of fact, they had a couple contracts coming in. But when sellers seeing all cash, and it was an all cash competitive offer also. It's not like an all cash offer. So it was also a good offer, a fair offer. Not as high as some of the financing contingencies contract, but a good offer. So they see an all cash offer, no financing, no appraisal. And then also, quite frankly, what we do, from one of the banks that we have our money with, we show the seller, yes, we have the funds to make the all cash, to settle on the loan. So we show them funds, just like, most sellers want to make sure if you're making an all cash offer, can you support it with funds to close? And yes, we can, we do that. I think the last one we did, we had $3 million in an account. So we showed the seller what was in the account. So the way that works, so our agent submits the all cash offer. We win, we closed it like in 15 days. Okay, so the all cash offer closed in 15 days. Okay, then the agent who wrote the contract is now has the home in Falls Church listed for sale. Okay, now there'll be a second contract, and the second contract is going to be New American Funding as the seller, our borrower, of course, as the purchaser on the McLean as soon as the home in Falls Church sells. So it's really pretty cool. Now we'll keep going. Is it a perfect loan? Of course not. Is there a cost to it? Yes, there is cost. It's not free. But to make this point, the all cash program can be used with current property owners who have not sold their home. That when it works best. That's when it's most solid, but they need 30% net equity. But it can also be used with buyers without property ownership. Now, 2 years ago, a year ago, 3 years ago, buyers without property ownership, this is what that means. You have a client who can only put 5% down, and we're in a seller's market. Once again, they come in, we get them approved with the 5% down on that property that you're looking at, and then you present an all cash contract. So the seller doesn't see a weak 5% down contract. Seller sees an all cash contract. Now, in a softer market, may not be, because there's a price, there's cost to it, which we'll get to. So in a softer market, seller may be happy with a 5% down contract. Maybe there are not other interest in the property. So it just depends upon the market. I would say at the moment, you know better than me, but from what I'm hearing from realtors, that in spots, the market is softer. And I would think that's probably a fair statement to make.
Great. David, may I ask you a question, please?
Sure.
They look at the assets and they can see the asset is covered in that, but what about the ratios? If they have any debts, will that impact the loan? What is the guideline?
Not their house debt, not their current home debt, but any other debt that they, for instance, we're focused on the property that they want to buy. So if they have a principal, interest, taxes, and insurance payment, we do not include that when we're qualifying them for the home that they want to buy. So, and that's normally what keeps a buyer out of the market is, hey, we can't, one, we have our equity tied up in this current property, or two, we can't carry the payment. Like there's two issues, right? Like we solved both of those issues for our borrower. One, we didn't have to carry that $4,000 or the $5,000 house payment. And two, we write the all cash contract, then she sells her home, then she has the down payment for our McLean home. So it's pretty nifty. It's pretty nifty. Now, there is, there is a price to that, but getting to our first-time home buyers, this is also where it can work, assuming where it works the best if there's a lot of interest in the seller's property, because then you don't have to show them a 5% or a 3% down payment. You may be able, you can show them an all cash. We know it's going to be a 3 or 5% down, and we qualify them. So this first-time home buyer works best in a I would say more of a seller's market than a regular standard fair market. Okay,
Thank
now,
you.
sure. Now, these loan amounts are relatively the new loan amounts, if you notice. So Fannie Mae went to on regular 832,750 on high balance, which this area essentially high balance is now 1,249,125. So up a few $1,000s, but better than nothing. A VA loan on this program, we could go to $2 million. Incredible. So the programs, standard fare programs that this program can work with. So the 1 units, pods, condos, as long as the VA condos on the VA. Now, if you notice, this program is not for FHA loans. So it's not for FHA loans. And these are some of the requirements. There is, this is probably, now for your high-end buyers, a 5% EMD is, for instance, on this $900,000 property, our borrower was required, we required our borrower to put $45,000 into it, 5% EMD. So that is a requirement to participate in the program. On the new property, if it's less than $1 million, we want a 5% EMD. If it's over $1 million, we want 10% EMD. So over $1 million, like on $1.1 million, that would be $110,000. But that is a requirement from New American Funding. Now, and that's on conventional loans. On a VA, that earnest money deposit is a lot easier to swallow. 1.5 up to $1 million, 3% over $1 million, and must be liquid at the time of the cash offer. So when we made that 900,000 offer, it was actually 950. But when we made the 900 that offer, the borrower had to show us in bank statements that they had that EMD, because she had a ton of money tied up in her current property, but she had to show that she at least had 45 to 50,000 cash available, which wasn't hard to do. And of course, it goes to the title agent. So the borrower must submit the EMD to escrow agent prior to us making the offer. And the down payment and closing cost at the time that, so we closed it. Now our borrower selling their homes. Now, when we sell it back to our borrower, there are fees, and we'll go over the fees shortly. And once again, on the all cash offer, no financing contingency, no appraisal contingency. On conventional loans, on the VA loans, it's a little, there is an appraisal contingency, but we do a conventional appraisal, not a VA appraisal. So VA loan, it gets a little more complicated, because in the all cash offer, we do have to put in an appraisal, a conventional appraisal contingency.
David, you said that EMD is supposed to be in title company before to make an offer, but what EMD amount supposed to be in title company? If
Up to $1 million, it's 5%. So it's 50,000, 5% of the sale price. So if you have an 800,000 sale price, it's 40,000. So it's literally 5% of the offer price on the subject property. Like the subject property in the example that I was giving you, the subject property was the McLean property. They were asking in the vicinity of 900,000. So
okay, before to write an offer, the buyer is supposed to send the AMD to the title company.
yeah, basically, you see, we were at a point where they had the contract offer written up. Okay, it was written up at 9:07. So it was a wire, literally a wire that morning to the title company. So we can do it pretty quickly. So yeah, the contract ready to go. Okay, you've committed to 900,000. So let's get that wire to the title company. We have an all cash, like, we have a separate department that handles these all cash programs. And quite frankly, it's really I would say, to say they're on top of it would be an understatement. To say they're on top of it. The people that are that essentially handle, like, it's effectively the people that handle it are me, as acting as a loan officer, and our rep from the New American Funding that's assigned to contracts in Virginia. And these people do a pretty good job. So things happen pretty darn quickly. Like POP, we had that wire in, acknowledged. They write then they submit the contract. Let's just say that contract was rejected. They take the wire back. So that was pretty, I'd say, to say it was a quick process would be an understatement. So, but they do have to have that EMD before we will submit the all cash offer. Now, when we resell the home to our borrower, there is a fee. Okay, so on that 900,000 sell price, we resell it to our borrower at 2.2% of the night. So that's another, say, $20,000. So we paid 900, we're selling it to our borrower for 2.2% on that. Now, the good news is that assuming that we could get an appraised value, which is not real hard to do. Let's say the borrower wanted to put 5% down. We would have done 5% down, say on a 924, 928 sale price. Meaning you could finance that 2.2% in most times, assuming when we do the appraisal on the property, on the buyback, that we get the value, which, and I'd say, quite frankly, in many cases, we will be able to. So that 2.2% fee can be financed back into the loan amount. So we go out and do an appraisal on that property at 928. We do 5% down on 928. Although in the scenario that I'm talking about, it was like big time money down. So it really, we didn't need to do that, but we can absorb that 2.2%. So this is a quick example for you. NAV cash, so we purchase it for 500. The so you, the realtor, writes the first contract, and then you'll be writing the second contract. At 511, let's say it's a first-time home buyer, they put 3% down on 511. Not bad. Now that's a scenario where they don't own property. So these are properties that they don't own, so we can do it. That's the beauty of it in a seller's market where effectively we're not showing the seller, hey, we're presenting a 3% down loan for 500,000. We're submitting an all cash contract. So in a seller's market, this could come in darn handy. But like I said, probably more popular a year or two ago than it may be today, but still, something to keep upstairs here if you need it. So that's an example for a buyer who does not own property, who is putting minimum down in a seller's market where what the seller sees only is the all cash contract without an appraisal contingency and without a financing contingency. And once again, we have already approved our borrower at that sell price with the 3% down. So we're good. We know it's going to happen. Okay, the borrower can occupy the day of closing on the all cash offer. So we close, borrower can occupy. Another, like I said, no program is perfect. So another negative is that from day one, the borrower has to have a short-term lease until closing of their purchase. Now, if they don't have a home to sell, I would allow for 10 to 15 days on the buyback. If they have the home to sell, obviously they have to sell their home first. So that lease can linger if they have a home to sell. So the borrower will pay daily rent until closing of the loan, and it's collected at closing. It's collected at closing on the buyback. All utilities to be placed in the borrower's name day of settlement. Borrower responsible for taxes, HOA fees. So, effectively, it's all on the borrower's shoulders the day we settle. Now, once again, if they have a home to sell, the key is to have 30% net equity, and that's going to be based on like an AVM, CMAs. We'll take a look at CMAs, but we'll be looking at an AVM now. What we have seen is because we could use liquid assets, 401ks, it makes that 30% net equity a little easier to get to, depending upon that individual situation. When they own a property, that current property monthly debt not included, like when we're qualifying them on the new home, we're not taking into account PITI plus HOA fees. That's the beauty of it. That's the beauty of this all cash when they have the 30% net equity. And then must list their home within 7 days of the all cash settlement, which is not too hard to do. Now, this is the lease agreement. So, that, like I said, the 2.2%, now we're talking about Virginia properties, 2.2%, that's the add-on. And then, so that million, say that 900 to $1 million, that's $5,700 a month divided by 30 days. They pay it on a daily basis. So if it's 10 days, it's 10 times, it's not 5,700, literally paid on a daily basis. But that's the lease agreement chart for you. And this is the 5-step process. And there is a 1-hour seminar for anybody that's interested, for any of you all that are interested, email me and I could send you the link to, there's a 1-hour seminar for realtors it gives you an overview. Essentially, basically, you've already gotten a pretty decent idea, but it gives you an overview. And then it allows you to participate, to be, like to present the all cash contract. So, this is, I mean, obviously, our borrowers are pre-approved for the new property before you can submit the cash offer. So first things first, you send the borrower to us. Okay, some agents may ask, well, how long is it going to take you to pre-approve a borrower? I would allow for 5 days, 6 days. Like your borrower's organized, we push it to our underwriter. Our underwriter literally underwrites the loan. So we need a pre-approval from a New American Funding underwriter before the cash offer is submitted. So really it could be like it worked very well on this last one that we did. So, something to keep in your pocket. And what it can do, see if you're thinking about, okay, who do I know that doesn't want to hassle with putting their home on the market, selling it before they buy the next one? This may be, okay, what baby boomer do I know that we could go to? Hey, you have a ton of equity in your property, you may want to buy down. Let's find that property to buy down without any imposition on like one, carrying your current property or squeezing equity. The only thing they do need is 5% EMD. So if they're looking to buy down, say, to a $700,000 property, the only cash they need on hand is the EMD, $35,000. So that could very well work with baby boomers, or obviously any buyer that has a lot of equity in their property or has a lot of cash savings, 401ks, that doesn't want to go through the hassle of selling their property, but may want to buy a new property. But thinking about it, I do think could get baby boomers moving, or not necessarily baby boomers, but people that have owned their home for many years. But certainly baby boomers who are thinking about downsizing. So just food for thought. Or if you're in a tight seller's, if it's a popular home, you don't have to show that seller, hey, here's our offer, 3% down payment. If they have the EMD, now that may be the trick. They need the EMD, of course. Now, these are for people who do not own properties. Okay, so I did go through that pretty quickly, but if you do have questions, feel free to give me a call. In Virginia, the reason I mentioned in Virginia it's a good, it works well, is because it's 2.2%. Maryland and DC, it is higher. Like our charge is higher because closing costs are higher in Maryland and DC. The bridge loan is, this is where it's different, because you can get bridge loans anywhere at any time. But this is where ours is different. One, we'll do 80% of market value based on the CMA. So 80% market value. Two, we don't include, so obviously the bridge loan, that would provide the necessary funds for the buyer to purchase a new primary residence. That's the purpose of the bridge loan. So we take 80% of their current property, we pay off the debt. And then that remainder they use for the next property. Now, what is different about this loan, what's positive about this loan, is that standard fare bridge loan, you get the bridge loan, but you have to carry the entire payment, principal, interest, taxes, and insurance in order to buy the new home. And that's where a lot of bridge loans fall short. On our bridge loan, what the difference is that principal and interest. Let's just say it's a $600,000 sale price, or okay, let's use this example. So we have current market value of 725. Take 80% of that, 580. Let's just say they have a 400,000 balance. They get 180 to buy the next property. Okay. So we have less some closing costs. Now, this bridge loan, it is expensive. There's 2 points. So they have 166 for the new purchase. We do not carry the principal and interest on that $580,000, that P&I, we don't carry the debt. We do carry the real estate taxes, insurance, and HOA fees. So that could help. So there are no monthly P&I payments on the bridge loan to carry as monthly debt on the new loan. Makes it easier for your client to qualify on their new primary residence. They're on that current loan now, we do charge interest only. They do not have to pay no monthly payments, and they pay it back at all one time. It's literally a 12-month bridge loan. So they do have to put their home on the market, sell the home, and then pay off the bridge loan. They have 12 months to do that. So once again, the strength is there are no monthly P&I payments on the bridge loan. And that's what makes it different. Qualifying, of course, is solely on the new primary residence. And the monthly taxes, insurance, and HOA fees on current home will be carried as a debt qualifying for the new purchase, which I've already addressed. Now, this is the minimum bridge loan is $250. That's the minimum bridge loan. Most likely, they're going to have some type of a current balance. So you take 80% of the market value less their current balance. The remaining is down payment for the new home. So in our high cost areas, 1249, regular 832, 750. That's the good news. Ratio standard fare 50 DTI. Minimum credit score on this program is 700. Current home, okay, now on this bridge loan, when we say listed, it doesn't have to be in the MLS, it just listed. Like you could have a pocket listing, that's good enough. So on the bridge loan, the home does have to be listed. On the all cash, no, it does not have to be. Okay, so obviously we have to approve our borrowers. Interest only on the current property. Now this is the rub. It is at 10% interest only with 2 points. And on the current property, they won't do over 1 acre maximum. So in general, the bridge loan, a little different, expensive. The all cash offer is, I think the all cash offer is a big winner, quite frankly. That's how I see it. The all cash offer, I think the bridge loan could induce some people, hey, I could qualify for a new property without selling my own property, but then they do have to swallow a 10% interest only on their current home. They do have to swallow that, but that could work. It could work. The all cash that's a winner, in my opinion. That's a winner because 2.2% is relatively modest. That's relatively modest. But, and like I said before at the beginning of this webinar, that DSCR, these are just things that I think about. Okay, how can we create new business? And then same with you. So that self-employed guy that's knocking it out, but not declaring income, but wants to buy an investor property, you have an avenue for them to buy it with fairly with 25% down payment. So maybe maybe something to think about. Maybe something to think about. Or if we're doing a full doc loan, that same, like that Uber driver or Lyft driver that's making that 120K to 140K, but claiming $35,000, $36,000 in income. Use the 1099, take 10 to 15% of that as expenses, and we have a winner. So the programs are out there, and see, these out of the box programs are also decently priced, but in my opinion, it can maybe give you some ideas to create some new business for yourself. It's just like real quickly, and there are many first-time home buyer programs out there, but if we're talking about a true first-time home buyer and a Virginia housing loan, if they have a 680 credit score, so if getting to a Virginia housing, 680 credit score, and they're currently renting, and I've addressed this before. So we have a Virginia housing, first time, they're obviously first time home buyer, 680 credit score, and they come to you, hey, we want to rent something in Northern Virginia. Let's just say you're getting close to a $3,000 rental. And they're currently renting, they don't believe they're buyers, but if they're renting, that means they must have the income to rent. And obviously they had that, so they must have the income, they must have the credit, and they had a security deposit if they're currently renting. So they come to you, hey, we want to rent for maybe pay up to $3,000 a month. So if you're going to find them a rental, you're going to need the first month's security deposit of $3,000. And then you're going to need first month's rent and security deposit, $3K. They will need $6K to get into that property. First month's rent, 1 month security. Virginia housing, 680 credit score, first and second, 500,000 sale price. They'll need, without seller contribution, a total of $7,000. So my bet is that many renters have no clue that with a 680 credit score, that they could buy a property for $500,000 with a $7,000 total investment without seller contribution. So just more food to think about. Okay, maybe a tenant list. But now they do need a 680 credit score, and it's essentially, that's the Virginia Housing First and Second program that allows them to get into that property without a seller contribution in the range of 7,000 max.
David, are you popping those numbers out with the FHA or conventional?
Both on the Virginia Housing, either or. On Virginia Housing, either or, 680 credit score.
Okay.
Either or. So at any rate, packed a lot in. It's a webinar, and and the reason I brought these other programs up is because, in my opinion, ideas to create some new business for yourselves, like when you think about it, like that, especially like that Virginia housing, these people that are renting, that think they're stuck, that think they can't create wealth for themselves. Pop, they're in $7,000, they keep it 2 or 3 years, say 5%, and that's their first investor property. So you don't have to be a millionaire to build wealth. For these young people that are disciplined, can do it. And why let the landlord, why pay rent to create wealth for the landlord when they're very close to creating wealth for themselves? So at any rate, feel free to give me a call. I'm good with questions. I can answer them quickly, and don't worry about fortunately I have agents that that call me that I do some decent business with. So if you have your favorite loan officer, that's okay. It takes me just a couple minutes to answer a question. So hopefully some of this helped you, and I do appreciate the questions, good questions, and hopefully we'll see you soon. Maybe I'll be doing some webinars with Cindy, January, February, March. We're going to play that by ear, but it's been a great experience with Cindy Bishop over the years. I think
Thanks,
I've
Dave.
been with Cindy, since 2015,
10.
16,
2010.
10. Whoa.
Mhm.
Okay, getting.
So long, I know. I'm getting old. That's
Yeah,
how long we've been
it's
doing it.
flying
So,
by,
but I do
flying.
appreciate it. All right. Well, I'm also make sure that you send out the PDF of the
Yeah.
slide deck so they have your contact information as
Will
well.
do. Will do.
All right,
Okay,
guys.
good
Have
deal.
a nice holiday. Take care.
Okay, thanks. Thanks,
Bye.
everybody.